Welcome to our virtual update for the third quarter of 2021, which we have called Adapting to Life Amid a Pandemic. I am Adrian Cronje, Chief Executive Officer and Chief Investment Officer of Balentine. Joining me today is Gabe Lembeck, our Director of Research. Before handing it over to Gabe to provide details on our views on markets and investment strategy, I thought I'd like to start today's discussion making some high-level observations about the past quarter, about changes to our investment strategy, as well as our outlook. So September certainly lived up to its uncordial reputation, serving up a market correction after 2 months of strong gains. Despite the pullback, the third quarter closed with the stock market posting its best back-to-back quarters since 2009. The remarkable recovery from the lows back in March, when the market lost over 1/3 of its value in just 5 weeks, has been fueled by 3 reasons. Firstly, continued progress towards more effective therapies in treating COVID-19 and a vaccine which is expected to be widely available by the first quarter of next year. As a result, many businesses have reopened under stricter protocols to prevent the spread of the virus from overwhelming the healthcare system during the fall and winter months. Secondly, the extraordinary measures that the Federal Reserve and US Department of the Treasury have provided to bring relief to the economy appear to have been effective. Unemployment claims have fallen from over 17 million in July to just over 11 million in September as furloughs have abated. Evidence that the pandemic has accelerated trends which will ultimately lead to productivity growth is the third reason for this market recovery. Businesses have rapidly assimilated technological innovations as they have adapted to this new normal, which will provide tailwinds to the future economy and its profitability. As a result, the stock market regained new all-time highs in late summer, indicating the bull market had resumed and that the precipitous declines of early spring could be seen as a severe but temporary correction as opposed to an extended bear market. Many today anticipate a continuation of the sharp V-shaped economic recovery. However, we believe such conjecture ignores 2 very important points. First, the economic recovery has been uneven. In our view, the shape of the recovery should more correctly be stylized as K-shaped, depicting how after a sharp fall, the divergence in fortunes between winning and losing sectors during the pandemic has accelerated. We have clearly not all been in the same boat during the storm as we first observed in early May. And by the way, for those of you who have not had a chance to view it, I would encourage you to listen to Chairman Robert Balentine's message available on our website. While the technology sector has boomed and the manufacturing and residential housing sectors have also helped to boost the recovery, many sectors which depend on people gathering to do business, for example, in the leisure, hospitality, travel, and retail sectors, have unfortunately been left stranded. The energy and financial sectors have also experienced lasting collateral damage as oil prices remain depressed and the prospect of ultra-low interest rates for several years casts a long shadow. The second point we would make is that the pandemic has caused permanent changes to the world in which we live. These will have profound long-run implications in many areas. And we've explored these issues in our Road to Recovery series, which is available on our website. There we have assembled panels of subject matter experts over recent months to discuss the strategic impact on private capital markets, on innovations in the global supply chain, on the post-pandemic economic recovery, whether business owners should consider buying, selling, or holding their companies, and also on the future of higher education. And so the speed and severity of the stock market downdraft, bearing those 2 observations in mind, an equally sharp but uneven recovery has demanded an unemotional, disciplined, and highly selective approach to successfully navigate. We believe our investment strategies, which we designed to help our clients meet their financial goals with the highest probability of success, have performed very well during these challenging times. So let's turn our attention briefly to capital market returns and investment strategy and start with the public, bond, and stock markets. As I said before taking a breather in September, the areas which outperformed during the second quarter continued to lead the market rally even more robustly by the start of the third quarter. In August, the stock market had reclaimed its pre-pandemic all-time high, and our discipline led us to trim our position in gold bullion. The market continues to signal that we are set for a period of gold outperformance, fueled primarily by concerns over the long-run consequences of the sizable monetary and fiscal stimulus, and also what that might mean for the value of the US dollar. So our strategies have benefited from the strong rally in the price of gold since we established that position earlier this year. When trimming our position, the gains were short-term in nature for taxable clients, but they were offset by the significant tax losses we generated during the spring of the coronavirus crash. Our models, which dictate how much risk to allocate in portfolios or how much we allocate to stocks over bonds, are still not leading us to conclude that stocks are extremely expensive relative to bonds. That is a precondition which normally signals a high chance of an extended bear market, as evidenced in 2000 and in 2007. With short-term interest rates at zero, and the Federal Reserve indicating it is not likely to act until 2023 at the earliest, there seem to be few compelling alternatives to stocks. In fact, most Treasury bonds yield under 1%. So a dividend yield on the stock market of just under 2% provides a meaningful way to generate income for portfolios if it can be sustained and grown. Tilting our strategic allocation to equities toward diversified dividend-paying stocks is just one tool we are using to help generate portfolio income in such a yield-starved world. Earnings for the S&P 500 index are actually expected to grow by more than 25% in 2021, bringing its forward price-to-earnings multiple down to around 21 times. That is still about 40% above its long-run average, but we expect multiples to be higher than the long-run average, with interest rates staying this low, because that means that future cash flows from stocks have to be discounted at a lower rate. Though elevated by historical standards, if these earnings expectations can be met, the comparison of dividend and earning yields against Treasury bond yields therefore still do not represent an extremely overpriced stock market. The yield curve, that is the difference between long-term and short-term Treasury bond rates, another key set of criteria that we monitor, also remains steep against the backdrop of stable inflation expectations, signaling the Federal Reserve's stance is accommodative of future economic growth. Corporate earnings have continued to exceed expectations so far, given the size of the economic shock experienced during the Great Lockdown, and we see no reason for it to do any differently for the foreseeable future. Moreover, stocks continue to enjoy the tailwind of positive momentum relative to bonds. One measure on which we are keeping a close eye is the rate of change of corporate bond spreads relative to Treasury bonds, which we view as a very good proxy for investor risk appetite. These corporate bond spreads remain generally quite high, despite evidence that the pace of corporate bankruptcies is starting to slow. However, most of the weakness is concentrated in the distressed energy sector. Within our allocation to stocks, our discipline is indicating we should continue to emphasize growth over value and large capitalization over small capitalization stocks. Many pundits have pointed out that stock market indices have become alarmingly dependent on the performance of just a handful of stocks. However, we do not find these to be concerning. While Facebook, Microsoft, Apple, Google, or Alphabet as it's now known, and Amazon may make up only 8% of the sales of the Russell 1000 stock market index, their 14% contribution to the net income or bottom line profitability of the Russell 1000 index is actually not too far away from their market cap weight of 18% today. We also continue to emphasize domestic stocks over international exposure. The decline in corporate profits in the US was less severe than in international markets this year, resulting in a lower hurdle for the domestic economy to return to previous levels of activity, output, and profitability. In addition, we observe that the pace of the American recovery is off to a much stronger start than in international markets. With all that being said, though, We are seeing signs of strength in other pockets of the market, both by sector and by region. While we continue to emphasize growth over value and domestic over international for now, strong breadth across the board gives us greater confidence in the sustainability of the equity market run in general, but also in additional opportunities and points of emphasis in the coming months. Let's turn to private markets. We believe it is crucial for qualified investors to build a complementary pool of private investments, as it can add diversification and much needed return to portfolios given the challenging outlook for bond and stock markets. Foregoing liquidity on a portion of a portfolio, provided, and I wish to stress this point, provided that 2 years worth of spending needs net of portfolio yield have been immunized in cash, can act to offset some of the headwinds of low interest rates and higher valuations in public markets. Our private capital managers continue to find opportunities during this pandemic. With activity beginning to resume in the commercial real estate market, our value-add real estate manager, Harbert Management Corporation, renewed realizations in their 2016 vintage fund. Harbert has now sold 5 assets and returned over half the committed capital to investors in that vintage year. Its 2020 fund is currently opened and positioned for a post-COVID world, with 5 deals diversified across sectors already on the table. While no realizations have occurred in our venture or growth equity funds, BIP Capital and Fulcrum Equity Partners have also had strong starts. So overall, our private capital funds are currently showing significant outperformance versus their public market counterparts. We have added 2 funds to our private capital lineup during the third quarter. The first is the Peachtree Distressed Opportunity Fund, managed by Peachtree Hotel Group, with a mandate of investing in distressed hotel opportunities across the United States, which were caused by the pandemic. The recession brought on by the coronavirus and subsequent shutdown has affected pockets of the economy in varying ways, as I said at the outset of our discussion, which has caused us to be cautious on a diversified distressed fund. We think the Peachtree Distressed Opportunity Fund gives our clients the opportunity to be more selective and to target stressed pockets of opportunity, of which hotels, in our view, is a major component. Secondly, we added Monroe Capital Private Credit Fund 4 to our lineup. That mandate is to originate senior secured loans directly to companies and private equity sponsors. Monroe is a Chicago-based firm founded in 2004, and they bring a credit-first, zero-loss mentality to investing. These loans are high cash-flowing securities with low loss rates, making them a very timely investment given the prospective low interest rate environment we are likely to have to endure. We expect both of these funds, as well as Fulcrum's 4th growth equity fund, to be open until the end of this year. Finally, let's turn our attention to the outlook. The investment strategy team are busy updating our long-term expected returns across the investable opportunity set, as we always do around this time of the year. Given the challenges of today's starting point, with 0 returns to low-risk investments and elevated valuations for riskier high-growth investments, it's clear that creativity will need to be required to meet client goals. We will continue to lean on the process we have deployed over several market cycles to remain disciplined, agile, and highly selective to help our clients get there. As a team, we expect 3 interrelated issues to influence the near-term outlook. Firstly, further progress in containing the coronavirus pandemic during the fall months as schools and colleges return to campus. Policymakers have come to appreciate just how blunt a complete lockdown across the entire economy is, given the enormous collateral damage it has on the economy and jobs. So in our view, we are increasingly likely to see more targeted lockdowns to combat flare-ups as testing and tracing become more available and effective. Secondly, there is the possibility of additional fiscal stimulus to bring additional relief to the economy. While the economic recovery has brought the unemployment rate down to just under 8% in recent months, the momentum in job gains is slowing, and there are clear signs of permanent job losses increasing. Unfortunately, bipartisan consensus on what to emphasize in such a package has been much more difficult to achieve than earlier this year when the economy was staring into the abyss. And then thirdly, and of course most significantly, the US presidential election. Since 1926, no president has been successfully re-elected when an economic recession has occurred 2 years prior to the election. Unfortunately, the possibility of a contested election looms large amidst a bitter partisanship. Markets will be particularly focused on what the result may mean for the design of future stimulus packages, corporate tax rates, and trade policy with China. Of course, a Democratic Party sweep in which it gains control not only of the White House and Senate and retains control of the House of Representatives is key to its ability to advance its economic agenda. So thank you for your time and your attention so far. What I'd like to do now is to hand it over to Gabe, our Director of Research, to walk you through further details on our views on markets as well as investment strategy. Over to you, Gabe.
Thank you, Adrian. Q3 was strong across the board, as can see in the first column. Across all asset classes, not only domestic equities, but also international equities, commodities, REITs, and fixed income, asset classes posted strong positive returns. Key themes by building block are as follows. In our liquid building block, against the backdrop of interest rate cuts by the Federal Reserve, money markets and cash-like instruments have continued to see yields come down over the past quarter. Within fixed income, bonds continued their gains in the third quarter, with municipals returning around 1.2% and corporates returning 0.6%. Meanwhile, Treasury inflation-protected securities, also known as TIPS, rose 3%. This brings year-to-date gains for each to 3.3%, 6.8%, and 9.2% respectively. Within our equity building block, market risk, equities carried forward the positive momentum from their sharp rebound into the second quarter into the third quarter as well. The S&P 500 added almost 9% for the quarter, bringing the year-to-date gain to 5.6%. Domestic markets, as measured by the S&P index, continue to outperform international developed and emerging markets, both of which posted a strong quarter, as we have seen an increase in breadth across global markets. From a style perspective, growth stocks continue to outperform value stocks, and gold was up 3.6%, bringing its year-to-date return to 21.4%. We look at the yield landscape across fixed income. We continue to see a large disparity between government bonds, corporate bonds, and high yield. While the disparity is not as large as it was at the height of the pandemic in March, we still see where there are opportunities to be gained given the different yield disparities. Within fixed income, this would be a banner year in any other environment. After a volatile handful of quarters, yields in the US Treasury fixed income market remained in a calm channel as markets weighed the recovering economy with the upcoming political uncertainty. Investment grade spreads continued their trend for the second quarter, falling roughly 240 basis points since June. This was a tailwind for investors in credit as bond prices rise when credit spreads fall. The fixed income supply has been higher than normal across sectors. Municipal and corporate issuance reached $258 billion the first week in September, more than $60 billion higher than the average over the last 9 years. This was driven by strong purchasing from central banks across global markets, as well as additionally the desire for companies to tap markets to maintain liquidity to ride out the pandemic. Within equities, we continue to see a large disparity in growth versus value. Growth returned 13.2% versus 5.6% for value, putting the year-to-date difference between the two at an astonishing 35.9%. As has been the theme of late, equity valuations continue to remain more compelling overseas. And as the US continues to outperform, we continue to see this disparity grow. Importantly, as markets have been broadening, which gives us more confidence in the bull, we look at a checklist to see which indicators in 2000 and 2007 were a strong foreshadowing of market tops. And what we see now is, other than IPO activity, as the capital markets have a large appetite for new equity issuance, None of the other exist at this point. So we remain confident that the bull market continues to trudge forward, as few signs that the bull market has exhausted itself. Globally, as you can see, the quarter was strong across the board. And while certain indices remain down for the year, we see strength, a lot of strength consistently throughout the globe. We continue to emphasize growth over value and domestic over international. Strong breadth across the board gives us greater confidence in the sustainability of equity market strength. There continues to be heightened political uncertainty around the US election, as indicated by the VIX futures curve. Futures markets reflect expectations for this volatility, both around the election and further out, as markets focused on the risks surrounding the vote, particularly the likelihood of a drawn-out and potentially disorderly process to declare the winner. The federal funds rate remains lower for longer. Recent comments by Federal Reserve Chair Powell and other Fed officials indicate that the FOMC will maintain its ultra-low rate range through at least 2023 in order to facilitate a healthy US economy from the fallout of the coronavirus pandemic. Market expectations have aligned with that probability. As a result, we have seen balance sheet inflation both monetarily at the Federal Reserve and fiscally at the US federal government. We believe these trends will continue as long as necessary in order to allow corporations and small businesses to do their best to navigate through the pandemic. In private capital, our current offering to qualified investors are as follows. The AMG Pantheon Fund, Fulcrum 4, Harbert 7, we recently added the Monroe Private Credit Fund, and also the Peachtree Distressed Opportunity Fund, which is managed by the Peachtree Hotel Group, distressed hotel opportunities across the US. So when we look at attribution during the quarter and what worked and what didn't work, we would note that what didn't work was alternatives. They returned 1.6 in the quarter, outperforming bonds, but not stocks. What did work was liquidity, our cash immunization policy, as confidence in cash reserves enable clients to stay the course during record volatility. Within market risk, our relative performance as our equity themes in growth over value and the US over international continue to outperform their benchmarks in both up markets and down markets. And within fixed income, we remain invested in broadly diversified funds and leaned on our active municipal bond specialists to ensure high quality credit. Our underweight to fixed income helped our overall performance. With that, I will turn things back over to Adrian for some closing remarks. Over to you, Adrian.
Thank you very much for those insights, Gabe. I know it has been a very tough, grueling year in the trenches on the investment strategy team. Thank you to all of you who have been able to lean on our discipline process to help our relationship managers steward our client assets during these challenging times. We hope you found this update to be helpful. Thank you very much for the trust and confidence you place in our team and in our process. As a quick reminder, all of the resources that we referenced today during our discussion are available on our website at balentine.com, but please do not hesitate to call if we can answer any questions that you might have. Thank you.